That's what the Russell does every single morning. And then wakes up the next day and it says, no matter what the scenario is, it just says, let's just sell today, right? Anyways, guys, up next, we've got our next show host taking over. I do want to just give a fair warning. I'm telling everybody now because we are counting down, and on our team, we are preparing for this. We are launching our biggest sale of the year starting tomorrow. It's our April anniversary sale, 3 years since we launched the Edge Finder. We've launched a million cool new features, and we've got more stuff coming. Edge Finder's getting better every day. But the reason I wanted to mention that is so that if you are thinking about it and you'd like to get on the wait list concept, if you want to keep up to date with when the sale is live, it's going to be 40% off the lifetime access to the Edge Finder. It's a one-time payment, 40% off. If you'd like to get in contact with someone from our sales team to keep you in contact about that sale discount, we're going to drop a link here in the chat to speak directly to our support team. Take a second. If you don't want to miss the sale event, make sure, click the link being dropped in the chat, send us a direct message with this link here, and just let them know, hey, I just want to stay in the loop on the sale event tomorrow so I can get 40% off. Okay, guys, up next, Chris Pulver taking over the show. Stay tuned. We'll be right back after this.
Hey everybody, thanks for tuning in to today's A1 trading session. We love engaging with our audience, talking shop, taking requests, and sharing our favorite setups. It's about that time where we're going to review a bunch of indexes, stocks, currencies, gold, silver, Bitcoin, and pretty much anything else and share our insights. If you're wondering what trades I'm in, if you're wondering what trades I'm taking, and you'd like to see exactly how I'm trading everything, you can actually follow my trading signals. If that sounds like something you're interested in, we'll share a link in the chat. You can sign up. You can sign up directly with the link or speak to a support rep if you have any questions. If you're asking, what do I trade? Pretty much everything. Indexes, ETFs, stocks, options, futures, Forex, and crypto. Thoughtful analysis, active trading. Check it out. And now, back to the show. Hey everybody, happy Monday. Welcome back. Another fun day in the markets, yeah? Well, funny how this little de-risking that we talked about is, I mean, what's funny is we had about maybe a week to 2 weeks. I mean, as far as the actual push itself, it was a one-day correction. All the market did was stop bleeding, and then we had one push from this little chop zone all the way up to that big gap on Monday, and the market turned over Wednesday, Thursday, Friday, nasty day, nasty 3-day combo, enough for the volatility indexes right back up to the 30s. Not 30s. It's like in the mid 20s right now. But we came back to retest the lows. One thing I want to look at, I'll show you some clean technicals here. Big gaps to the downside. SPX, gapping from 55.85 all the way down towards 5,500. That's pretty big. You go to NDX, that was even worse. Qs, gapping from 469 down to 460. You go to NDX from 19, almost 300, all the way down to 18.9. That's a monster gap to the downside. Let me just talk technicals for a moment. Try to keep it pretty clean. There should be a macro workspace that I have here. So let's go SPX. Okay. One thing that's going to be interesting on the technical side is we are making some equal lows in price, relative strength showing some divergence. Okay, now I want to take a look at one other workspace here that I typically show, harmonics and pivots, just some tried and true levels that I play around with all these indicators. This is relative strength at 21, momentum at 20, gold making all-time highs. Somebody asked me today, like, Chris, should I buy gold? No, I'm not buying gold. I'm still up a bunch of money on my GLD positions. I took profits on gold futures, but this is one of the second or third largest stretches that we've had in gold ever, as far as time away from the 200 moving average and distance away from the 200 moving average. I don't know what the catalyst is going to be to drive gold lower. It could be a heavy pivot on the dollar. It could be some certainty in the stock market. It could be, I don't know. I mean, honestly, it doesn't matter what it is, because at some point I'll be able to explain it. The why will be in the news. Some outlet will have it. Some media narrative will follow along and say why gold is correcting. But technically speaking, it's due. Now, gold, real quick, is either on its way for some type of ridiculous capitulation move that I would be surprised to see, but also embrace if it gets to, I mean, I have no idea, but I'll just throw a number out there like 3,500. If we see another just exponential move where we saw this happen in cocoa futures, we saw this happen in lumber, we've seen this happen in copper, these big ridiculous moves. If I start to see something like that behavior, I will be moving stop losses aggressively. And once this thing pivots, it's either going to go into a longer consolidation period or this thing is going to go exponential and then it's going to crash. So I don't want to be, of course, left holding the bag after this thing rolls over and thinking, well, gold still looks good. Gold still looks good. Well, I should be taking profit on the way up, right? So I'm giving gold a little bit of a little bit of leniency right now to say, okay, well, a little consolidation is fine, right? Consolidation is fine. We'll play catch up. But if all of a sudden gold pivots hard and pulls back, this 200 moving average is my target. So if I see something that looks more bearish, I probably will take some stabs at some gold shorts, but not right now. And so again, the amount of uncertainty that we're seeing in the markets is pretty high. If gold is the reflection of that uncertainty, then gold continues to run hot to the point where it looks ridiculous and looks exponential. And there's good profits to be made on the longs. So I'm not calling the top. I don't want to call the top, but just know that a correction and reversion will happen. I would say a 99% probability that we are hitting this 200 moving average before the end of the year. I mean, I know that's a big window. I don't have to be crazy accurate there, but that's how confident at 374 bars and 15% overextended we're going to pull back to it. Okay. Now going into the indexes, here is SPX. Okay. Taking a look at some of these levels. This is the momentum oscillator and the relative strength index with a 21 period. Now I look at RSI 21 and I look at RSI 14. Both of them show pretty much the same thing. Price is at same lows, okay? Momentum disagrees and relative strength disagrees. That is hidden bullish divergence. Now, when I say hidden bullish divergence, this does not mean that this is a monster buying opportunity. I think at best right now, this market would see this as a potential rally again, back up to these highs, and then you're going to see the technical analysts out there talking about a bear flag that maybe gets worse, right? So, tariffs. Is this why the market's falling? No. Okay, it's a extra component to why the market is falling. But to me, mags is why the market is falling hard. Everything in mag 7 is down hard. We're at fresh lows on mag 7. It's still the largest chunk of stocks with market cap that's going to influence the entire market. So mags dropping in this rotation is the key why this was falling. And then on top of that, where it gets worse is this is the tariff fuel and the sentiment uncertainty. That's why the market got a little bit worse for wear. This was like the sixth largest, or not largest, but the sixth fastest drop over like a 45 or 50-day window. So pretty ugly, but it got uglier based on uncertainty surrounding it. But this next leg, so if we go lower, there's clearly more uncertainty. Okay. So I'll put this. If we go lower, would be more uncertainty, more kind of pain, where Trump is negative. It's like everything Trump says is about tariffs. Market hates it. So the market's going down. Fed is quiet. So no backstop, which you're a fool if you think the market's going to see a Fed put at 10%. The Fed as an emergency backstop level, it would be probably 20 to 30% from all-time highs. So I mean, honestly, I'll put a price here. I think between 5,100 and 4,800, that to me would be a backstop area. So if we're going to see like emergency anything, it's probably around those prices. That's way lower. We could flush double digits from the year performance. We could be from the all-time highs, I would say down closer to like 20% for the year from all-time highs. So I looked at, that I mean, 4,800 is the previous high from 2022 when the S&P peaked. It's like 40 to 48 and change. 5,100 happens to be what I'm looking at for like Q2 as a big put level from JP Morgan. 5,000, of course, is a big round number. So if you're not prepared for the markets to go down that low, this is why I said de-risking. You're going to have opportunities to do it. And we might see something like this. We might see this market from this fall, we went up for that 1 or 2 week period where the market just stopped going down. And then in 3 days, Wednesday, Thursday, Friday, and then today's open, we're right back where we started. So we're no better off. We're back down to the lows. But like I said, hidden bullish divergence on momentum and relative strength. If there's another short-term opportunity to buy as we kick off Q2, maybe there is. Why? Because April 2nd, that's Wednesday. Is there more clarity here? Right? Wednesday. Does Trump say something across the board that makes the market think like, okay, maybe it's not that bad? And this could be the example. Okay. This 20% global tariff in push for a big and simple trade policy. Well, he could have led with this in January instead of nobody knows what the hell's going on, right? Is it 25%? Is it, only for certain countries? Is it 100%? It's just been like threat, and the market hates it. But on top of that, what makes this worse is if the market has this, if the market has some certainty, it's like, okay, global tariffs at 20% across the board. Now we can start to see how these companies are affected with earnings. Does that make sense? With earnings. So if earnings is going to be affected negatively and it's not priced in already, then the market's going to continue to go lower. And so that's where this gets worse. And I think that right now, this is a sell the rally environment until price can prove otherwise. If the the bulls cannot close above this key level here, which is around 5,800 on the SPX. If the bears keep this defended and the bulls cannot close above this, this is a sell the rally environment, and we possibly have more to go. If all this market did was high, low, lower high, lower low, well, there's my 5,100, there's my 5,000, there's my 4,800 level. You can see all this demand down here, and all it is a symmetry move. There's previous lows from August of last year. Perhaps that's enough. Maybe it's enough to poke those lows from August before we start to see the market bottom, right? So there's all sorts of ways to see when and if this thing can bottom out. I think right now, if we're lucky, it would be a bear flag that would still offer up a short-term correction, but I would still be selling that rally, at least position for it options-wise. So hedges, I've got plenty of hedges going on right now. Right here, up about $5,000 in hedges between futures plays. I've got a SPY hedge as well. That should be looking pretty good. That one's profitable. SPX, we're about 55.10 today. That'll be looking good for profit. SPY, let me find my SPY hedges. Here's a hedge. Okay, so hedge. Just waiting. But they're out there in case I need them. When do these get more profitable? When the market takes another spill lower. So where to? Look left on your chart. These are the levels I'm talking about. Are we coming back to this previous high? Are we coming back to this previous high? Right? That's way down there. Like that would be the ugliness and the overshoot. But look at all this demand down here. There's a lot of demand. Okay. High, low, lower, high, lower, low, lower, high, lower, low. I mean, who knows how orderly it's going to get? It might not. It might not be. But look, I don't think Trump is ignoring the market. I really don't. But I think the government has a bigger plan, which is they're trying to get this 10-year yield to go lower. They're trying to, right? The thing I don't want to see happen right now for this 10-year yield is I don't want to see the Fed step in and cut emergency, like cut another 25, 50 basis points, do it before June, because my concern is that they would do it and it'd be the same reaction right here. Fed cuts, market reacts this way. Fed cuts emergency, Fed goes that, the yields go that way. That'd be my biggest concern. So if the Fed steps in and does something, and you can see Trump, putting pressure on the Fed headline-wise saying, do the right thing, cut rates. It's like, dude, don't cut rates. If you want to see a cycle where consumers can borrow and businesses can borrow and businesses can refi, you've got to see this 10-year go lower, and that comes with pain in the market, right? So the government is not really sensitive on the markets right now. I think this is, and this is the sad part, is we got to a point in the U.S. markets-wise, assets-wise, inflation-wise, it is like this perfect storm of the brink of things could get way, way, way worse, right? Our debt's already unsustainable. But if we keep operating at this pace, it's going to be like the fiscal cliff or the financial reset is getting closer and closer and closer, more imminent. So if there's at least some semblance of, hey, look, let's at least discuss the problem. Let's maybe address the problem. Maybe we can make an effort to try to curtail the problem. Then maybe the market deals with some short-term pain for some long-term gain, right? And that's the justification right now. I don't think the bottom is in. I don't think the Fed put us anywhere near it. So if you want to get aggressive on anything, I don't think this is time at all. We did come right down to the yearly pivot, by the way, so that's an interesting spot, maybe offering some short-term support. But if you're lucky, a basis or a base case for a bear flag might be kind of the best case scenario here for the next maybe 2 to 4 weeks. If the market just doesn't keep going lower, then a bull flag of, okay, we end the quarter on a pretty sour note. Q2 maybe gets us more certainty through April 2nd as maybe more clarity on tariffs are given by the market. Maybe that's the buy the rumor, sell the news. And if this is a flag, I'd still be looking to short this. I don't think the market has any all-time highs in the works because we would go from a extremely negative sentiment to extremely bullish sentiment to even come close to all-time highs, which I just think are a long ways away. So I am a sell the rally trader right now. I am a protect the heck out of your portfolio right now. I am insuring and hedging like crazy. And I'm trading what is working rotationally. So I like utilities a lot. Okay. Which still seems relatively cheap, but it's boring. It's not sexy. It's low beta. But if I can stay out of trouble and still generate about 3% and maybe have some price appreciation on top of that, that's a pretty good play in my opinion. A boring stock like MO, I'm just going to keep rolling some of my calls and collecting income here. On BTI, same thing. I'm just going to keep rolling calls, adding more puts. These are low beta stocks, by the way. 0.09, negative 0.09. Like it has zero relationship to the S&P. Okay. PM, same thing, right? 3.5% dividend, like super, super low beta, negative beta. Like it's not correlated at all. This is where I would be hiding out. High dividends, reasonable performance and price appreciation. But obviously it's cheaper going like MO is a little bit cheaper. BTI is even cheaper than that. So I don't mind those at all. And we've got some nice resistance up here towards like $45, $46. If you pair that with a 7.3% dividends, yeah, I like that a lot. Okay. Meanwhile, on the growth side, take a look at MAGs. This is what I'm saying. If the MAGs doesn't go up, the market's going to continue to stay in trouble. So this is all part of that rotation. This is why the market's down as aggressively as it is. I mean, this high to low, by the way, is around 24% MAGs, right, from peak to trough, and the markets are down 10 to 11%. We had some fresh lows today, right? Nasdaq is down. So I mean, a big contributor to this market selling off is this rotation out of MAGs. So here's your look. Apple hanging in there. Amazon quite a bit lower, like fresh lows on Amazon down to 185 from this little pullback towards 205. Amazon earnings, I mean, we're not going to really have Mag 7 save the day until earnings season, which is going to be probably 3-4 weeks away. Broadcom, little fake of the 200 moving average. Broadcom's been selling off aggressively. I'm not touching this one with a 10-foot pole. Google, I've got trades on Google out to, let me check the workspace here. Google is, man, that's just a nasty drop. I've got some dollar cost averages in, got a 150 level I'm looking to buy. That didn't get filled today, but it's close. This trade was profitable, so this was close for profit. And then May and December, if we just stay, I mean, I may take some assignment here, but we'd have to stay below 150 for me to take assignment. Which I understand. I could take assignment, but this high, this low, possibly this August 4th bottom, if the bounce is there, it's right around that 150 handle. So I'm looking at these as potential income. If I took the assignment, I would repair it. I can flip this stock pretty easily for some profit. Okay, Meta back down below the 200 moving average. This is why I said I don't want to get long. I talked about this in a like right at the 200 moving average. We had like a 2 to 3 day jump. But expiration wise, I'm like, I feel comfortable going out about 30 or 40 days, but I think this is still going to drop. This, if you think about 2022, Meta was down 70% from the highs. If this market wants to deleverage, Meta is going to get smoked. Tesla is going to get smoked. Mag 7, maybe outside of Apple, Mag 7 is going to get smoked. Nvidia might be back down to $100 or less. So, I mean, this run that we've had on some of these Mag 7 stocks, man, you can easily get like a 30% haircut, 50% haircut on some of these trades. But they're still great stocks and everybody knows it. But man, The next time they become a fantastic value play is when they've just been beat up so badly, right? So, I mean, maybe that's the play. Microsoft, also down. This one is, I think I've got one trade on Microsoft, which as long as we're above 370, which I'll see, this has to be a gap fill. Okay. Otherwise, I wouldn't mind taking the shares. This isn't on every account, but I'll take some shares and also repair this for a little income. Okay. And then as far as dollar cost averaging, I mean, look left on this chart. There is some semblance of resistance there. If we get a bounce, there's certainly some levels down here. So if we came into like the 350 handle, I probably just dollar cost average into Microsoft anyway. There's also a yearly five period yearly average right there, right around 330. So how nasty does it get? Well, high, low, lower high, lower low is probably playing out. So do we have another channel? Is it a bear channel? Is it just falling off a cliff? Nobody knows. But I still think these are, great stocks to have, but also if you're going to own it, protection is going to be key because who knows how nasty it gets. Netflix gapping lower. That broke wing butterfly up here is good. Nvidia back down to 104. And I'm curious if this August low, I'd say $100 is a pretty key level. I've got a bunch of premium sold at like the 75 and 70 put level. I think that Nvidia, I mean, fair value is like 125 to 130. Any substantial discount here, I think we have some support in like the 90 zone or the 76 zone, and that's like worst case scenario. I know that nothing good has been coming out of news for Nvidia lately. There's tons of competition in China. Right now, this whole notion of AI build out, AI infrastructure, semiconductors, like it's all momentum and its growth. And right now, the markets are running from it hard. So I think you're gonna you really have to like work through the pain because I don't think these bottoms are necessarily in. Tesla trading at 246. Let me take a look at my covered calls that I have. I got 300 shares of Tesla, and it is shares covered call. I've already pulled in about 72% of that covered call, and I might roll it again, but I might. It depends on if I roll it for the same strike or I roll it down. My break even in Tesla is now down to like the low 220s. So I still have income opportunities here. If we stay above 247.50, it could get called away by Friday. I may consider even rolling out again and again and again if we let's say that April 2nd doesn't look too terrible. The market's going to kind of price in this like blanket tariff policy from Trump. Then maybe Tesla goes back up and I'll roll it another week and get another. I mean, I got like $250 more income. So if I can do that on three accounts, then I'm looking to maybe generate, every roll that I do, maybe another, $1,000. So I'll now that I own the shares, it's like I might as well utilize them. Might as well sell covered calls. Might as well work the cost basis down aggressively as I can, and see what I can do on this overall trade. TLT is up to $91. This one's out to the end of the month for a diagonal spread. I'm up I think I'm up like close to 10 grand on TLT positions right now, and we're making a decent run to the upside. So it gets called away if it's above 92, which is the end of the month. So if we see more pain in the stock market than the bonds rally, it's very possible that we see the TLT move higher. However, I'm still watching the U.S. 10-year. If U.S. 10-year isn't going lower, we might see a struggle bus on bonds on the longer end of the curve. Okay. All right. So Berkshire, interesting how Berkshire is up on the day. I still would kind of like to short this one. The premiums just weren't good enough. I looked at it last week. This is 1 to 3 year. This is 7 to 10 year. This is the 20 year. Gap up and fading. I don't know. This could be this weird head and shoulders pattern. There's a high, maybe a flag right here. This could be a nice little look, which doesn't look good for stocks. If bonds go higher, it doesn't look good for stocks. But it looks okay for yields. If yields finally drop, markets go down, bonds go higher, TLT long is not a bad play. Okay, that's good. Yeah, currency strength. The U.S. is starting to trade like an emerging market. Okay. Here's another thing. Everyone's been talking about this. Germany's doing well, Europe's doing well, Euro stock's doing well, FTSE's doing well, China's doing well, emerging markets doing well. Look, I've been talking about it. If the U.S. goes into recession, that rotation is going to be so gross. Like Europe is going to hit a wall. China's going to hit a wall. Like you can't have emerging markets run hot with these crazy like ex-US gains if the US is not in a resiliency state or at least a bull market as well. I can see outperformance, but I don't see US down 10, 15, 20% while everything else is up 15, 20%. That doesn't happen in the global economy. So I think that if the world wants to see gains this year, the US better have some resiliency because it will quickly turn from Europe's up, 15 to 20%. Well, now it's back to zero. Like that can happen so easily if the US market is going to get worse. For the day, we have New Zealand weaker, Aussie weaker. This is today, right? Yep. Here's today. So we got the dollar catching a bid. Dollar or the yen cross was a little bit stronger this morning. Aussie, New Zealand weaker. This is risk off trading. CAD a little bit stronger. Swiss is still baseline, but nice seeing a little CAD rally there. I do have some levels in. I've got all my Swiss pairs here for currencies. So Aussie Swiss, I'm still dollar cost averaging in. CAD Swiss, I'm still dollar cost averaging in. Euro Swiss, still in this one. Pound Swiss, I'm still holding in Tasty FX. I haven't added anything else to my other accounts. This one's okay, but not my favorite because the margin's still high in it. So I'm trying to thin that one down. New Zealand Swiss, I'm leveling back in towards these lows. And then dollar Swiss, oops, wrong one. The other dollar Swiss, still hanging in there. So I'm leveling in. If we get to 86, 85, 84, I'm buying more dollar Swiss. You could buy it here to start small. Just buy some more. We'll probably get back to 92. But small, 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 small. And then once we confirm a low, then I stack more orders to the upside, just like I did here. Had lots of buying opportunities, broken trend lines, lots of buying opportunities. And when it hit 92, I closed out all my positions. So I'm looking to get back in. Sears says, I was hoping for the dollar Swiss to tank. I mean, why? I wouldn't mind it steadily falling, but I don't want it to tank. Like, I don't want to see fresh lows on the dollar Swiss. I want to see range lows, and that should be orderly, right? Like this level, this level, this well, okay, fine, and then give us a bull pattern, and then we come out of that and we get all the way back to 92. Brilliant little range trade. That's to me a lot better. So look, I don't want to see a flash crash in the currency market. Nobody does. Nobody likes it. Granted, I'm positioned for it. I've traded through 15 years of flash crashes, and I trade super small. I usually work out on the wrong. The one flash crash I got caught on the wrong side of was one trade in October 2016. It was pound Aussie on a Brexit flash crash in October. That one caught me off guard. It was like a 1,000 pip flash crash overnight. I ended up liquidating for about a 10% loss. It sucked. But I was over leveraged. I had multiple standard lots running, and it was way too big. I was in an immediate drawdown, and price came back to some state of efficiency. I just closed it out, ate the loss, built my way through it by January, February the following year. So that was October. So February the next year, I'm back up to fresh highs. But it was an ugly way to kind of have a flash crash damage me. But 2015 Swiss National Bank did totally fine. Oil crisis in 2014 and 2018 did fine. The yen trade in 2014 or 2012 did fine. The dollar pairs in 2014 did fine. Flash crash in COVID, that did totally fine. Trying to think, do we have a flash crash in 2022? We kind of did. 2022, we did briefly when the market hit lows. We finally bottomed out on some of the Swiss pairs and yen pairs. And then in 2024, we had that August flash crash. So it just, they happen. They happen. It sucks. If you're not trading small enough, flash crashes and currencies will destroy a lot of traders. So you got to trade small. This is why I take bites in the markets and Forex. I hate the noise that the markets give us where, oh, this is good. I'll put a stop loss here. What does price do? Comes right down to it, spikes below, spikes below, spikes below, spikes below, and then it goes your way. And you're like, well, what the hell do you do to manage that? Here's what I do. I trade small and I give myself room to be right. It's not easy. If you trade small, you take care of the drawdown. If you're trying to say, well, I only risk 1%, Chris, right? But 1% gets tapped multiple times. And then you have 3, 4, 5 losses, and then it goes your way. And you're sitting there no better off. You lost money, frustrated because you're trading defined risk and you're putting stop losses in. This market hunts stop losses like no other. Futures market hunts stop losses like no other, right? It's a tricky market. So deleverage and trade smaller, and you'll get those positions that you can build on confirmation when things are going your way. That makes Forex for me a lot easier. All right, let's go some other top-down stuff before I wrap up here for the day. So where are we at? SPX at 55.37. Okay, fine. Let me check a couple of levels here. So we've pushed down 55, 65 should be a key level today. I mean, I wouldn't be terribly surprised if the market can fill this gap or try to at least. That's up to 55.70. But let's see what the day gives me. If I see price today above 55.10, if price on SPX today is greater than 55.10, then I've got about $1,000 of profit. That was a bull put spread that I put in. So I know you can't read that at all, but I need price to be above 55.10 by the end of today. So I can check that position here. Let's go SPX. There. So all these at 55.10. So if it can hold above that today, there's about $1.75, $1.80 per contract, and it's like 5 accounts. So just shy of about $1,000 on that trade. So yeah, I hope that happens. Hope we stay above 55.10. That would be, basically holding above the lows, right? Lows at 5,500 or so, lows around 54.90. Stay above there. Don't finish at the lows today. That'd be kind of crappy. So we'll see what the day gives us. All right, so there's that. Let's go top down. Dollar index, SCXY, right back down to lows. I'm gonna wait on this one. I'm gonna wait for another sharp spike in the VIX if I get one. Dollar index catching a little bit of a bid today. I wouldn't be surprised if this is still a low, high, higher, low, higher, high. Watch for that. I mean, I started positioning on euro dollar for this last week. So we might still have a drop, right? It might be high, low, lower, high, lower, low. Trade one, trade two, look for a trend line break, add more on the right hand side of the trend line if the dollar is going to stay. This is what I need the euro dollar do. Stay above this 105 to 106 handle. Okay. So if we are making higher lows, higher low, higher low, higher low, higher low, draw a trend line out here, high, low, lower, high, lower, low. Something in there, right? So between 106 and 105, that should be key support. Yeah, we'll see what happens. But that's dollar index right now. Oil, gold, silver. Oil continues to head higher. This is also, I mean, I guess all the stuff I talked about was, I'm curious if this floor holds. Well, it did. So I wasn't long. I felt like this whole notion of the U.S. coming in, drill, baby, drill. Well, where is it? It's not driving prices lower. Here we have energy prices going back up. USO also higher. Natural gas, UNG, this is what I'm trading for diagonal spread. This one is a $23 call. This one should be, I mean, I'll watch it. I'll probably just end up selling more premium on it. Gold, making some fresh highs in the day. Silver, not quite there. Let me see if we get back up towards, this would be October 2024. See if we break those highs on silver. Bitcoin, surprisingly, Bitcoin, I've got to give it credit. Like, it's pretty darn resilient. It really is. Like, that's not a bad thing. That's not a bad sign at all to see some resiliency in Bitcoin. So as long as we kind of hold here in this like 75 to 70K zone, and this just kind of coils and coils and coils and coils, I mean, yeah, we might still have a risk on trade. It's going to have to be like, I would assume the bottom of the market's going to have to happen. We're going to have to have some type of risk on rally in the U.S. markets, because I don't think Bitcoin is going to be on its own island where it's like, hey, Bitcoin's up and the U.S. markets are down. I don't think it's going to work like that. But the nice thing is even with the markets dropping to fresh lows, Bitcoin has not hit fresh lows. So that's kind of encouraging, at least for the near term. When dollar's weak, why does CAD Swiss go down? I don't think those are correlated at all. I mean, CAD Swiss is up probably because of oil prices. Swiss is a potential like safe haven along with the dollar. So if dollar's down, Swiss usually gets stronger when the dollar's down. Especially if it's safe haven trade. But those are really not correlated. DXY and CAD Swiss are not really correlated. Anything on IBIT, trading around 47, nothing crazy there. MicroStrategy 289, lots of volatility. Copper hit all-time highs, but you can see a very sharp move. Let me take a look at China and everything else. Japanese yen getting a little bit better off. FXY for my Japanese yen trades and shares that I own. I'm chart alarm at 63. Set this other one at 65. New highs. Let me go $65. Close to August 5th highs. That's when that thing peaked. So when the August 5th bottom was in the markets, this was the top in FXY. EWJ, that's my, oh, fudge. Well, that was looking good for a second. Now it's back down. So a little bit of a pullback there for a couple of bucks. DXJ, same thing, a little bit of a pullback. Germany, bye-bye. If there's if U.S. recession risk get greater, Germany is going to go flat. I would imagine U.S. markets, if they're going to drag the entire global economy with it, it's going to be an interesting dynamic. See how it plays out. FTSE hanging in there, but Fez is dropping hard. DAX dropping hard. Argentina dropping hard. I want to see this one hit the 200 moving average. China not looking great. I'm not saying this is a topping pattern necessarily, but if this is at very least a support level, I mean, there's plenty of room. And look at these swings we've seen. Okay, up, pulled all the way back, up, pulled all the way back, up. I could see China pulling all the way back again, and that's a lot of volatility. But man, I mean, this might still be the behavior on China, so could be some opportunities, but not without volatility, that's for sure. Brazil still hasn't broken above the 200 moving average. That's my key level to get into a buy zone. Same thing on ILF for Latin America. Mags down. This would be a good gap fill by the end of the week, to be honest. If Mags can fill that gap, that might give the market a little bit of relief. Right? I mean, again, take a look at this from the technical side. Let's go to Mags. You're going to see a lot of divergence. So daily time frame, we just missed the oversold on the 21, but what you can see here is we have fresh lows in price, momentum disagreeing, relative strength disagreeing. That is hidden bullish divergence. It's a gutsy play to be long right now, but it is what I see on the technical side. This is where that kind of bear flag scenario plays out, right? Market has this gap. Market puts in a bottom, capitulates lower. Short-term buying opportunity that maybe gets a little bit higher becomes a bear flag. So we still have a flush, maybe some sideways correction. You know, is Mags really going to be what dumps? I don't know. I think this is close to enough pain. And I have no idea, but this is close to enough pain that if Mag 7 stabilizes, you know, right now the market has broadened out. It doesn't feel good when the market broadens out this way. When the market goes negative, everything broadens out because those that are overvalued are getting beat up. Like everything Mag 7 multiples were high and the valuations were off the charts. Like they're not good value plays any longer like they were 10 years ago. But that shed in Mag 7 has now allowed 490 stocks to start to, you know, perform less crappy. And now you have an opportunity to say, okay, do I want to buy something with a 30 multiple or a 10 multiple or a 12 multiple or 15 multiple? Because there's chance for price appreciation there and runway to actually grow, right? Like fundamentally, things are a lot stronger. So we'll see. But Mag 7 is still like you're talking about like cash, like very cash healthy companies that have, you know, some of the biggest moats in the world. But the market has to like it. If the market doesn't like it, or the deleveraging and you know, anti-momentum stocks are still going to get beat up, like Mag 7 could still be in for a rude awakening to go to the downside, and it's going to trouble a lot of investors that thought, you know, it's been the greatest thing for them the last decade, and here it is maybe like the worst thing to have. So I mean, I'd like to be like a bargain shopper on Mag 7, you know. In fact, I wouldn't be opposed to a, you know, August low or an April low. We start hitting some major demand. Maybe this is, and I'll just throw a number out there, a 50% correction. Just saying, right? Where would that be? Well, this ETF was started back here in 2023. We had nothing but a crazy run. I'm just going to go from low to high. Go from low to high. There's your move. So we're right around that 38% right now, which is a common fib level that should oftentimes lead, especially in the stock market. Usually 38% fibs might be all you get. But if we pull back in like the 50% zone or the 61% zone, there's more pain to the downside, but that also would be probably a great opportunity to start getting long Mag 7. So time will tell. Okay. And one thing, you know, this is why 2020 was such an unbelievable year. You essentially had, you know, a decade worth of discounts in a month. Everything was on sale for a 30 to 45 day window. Everything. So, I mean, in this type of deleveraging environment, keep an eye on some of your favorite stocks because they might be on sale. But I also want to look left in the chart and make sure that they technically make sense. Just because something's down, look, Tesla's down 60%. Does that mean that I want to buy it? I mean, I'm playing it, I'm buying it, I'm nibbling there, but Tesla could easily drop into sub 200. Tesla could be $150. There could be more problem. Who knows? It's still a crazy high valuation. but Meta could be down 50%, 60%. So just be careful where you're taking some of these bites on these stocks, unless you are just, hey, look, I'm going to allocate $1,000 dollar cost average. Then I wouldn't worry about it. But for me, when I'm positioning a lot with options, I want to make sure that I'm pretty happy with the lines that I'm playing. That makes sense? Okay. All right. So there's Mag 7 stuff. Let's go into, we did bonds. The 10-year has gapped lower a little bit, but it still remains very sticky. This is what I'm talking about. In order for the Trump administration to get a lower 10-year, okay, it's going to have to come with more pain in the stock market. I don't think, look, just because the 10-year has gone from 4.8 to 4.1, the reason that happened is because the market is down. So if we see higher prices in stocks, this is going to stay very sticky. It just is. So I don't know what this means outside of more pain to the stock market downside means, yes, the 10-year might fall along with it. But an emergency cut by the Fed, I don't think is going to be the right reaction for the yield market. Look at the inversion. We're still way inverted on the 10 and the 2-year from the zero line right here. So 10 and the 2-year, still way above the zero line. So we are disinverted. That means borrowed time as far as historical recession indicators. 10 and the 3-month, we are at the zero line. Okay. If this gets reinverted, maybe there's some borrowed time where it's like, okay, we somehow, had the 10-year rising sharper than the 2-year. I don't know. It's going to be close. I think. I mean, we've said this since this market ripped. A lot of this was with September. The whole crap that happened in the yield market last September when the Fed cut. That's what led to this 10-year 3-month getting disinverted. So we'll find out. Mortgages 6.65 is average. I actually might put my hat in the ring for trying to lock in something maybe around like the 6.5, 6.4, 6.3 zone if I can. I'll try to get the best rate that I can just based on numbers, but I'm definitely going to want to build in like a couple of refis over the next maybe 5 or 10 years if things get really nasty. But I don't want to see a higher interest rate than 6.5 if I can avoid it. All right. What else? China. We did China here. CQQQ pulling back. Alibaba pulling back a little bit. Maybe a bull flag if you're lucky. If you're lucky on Alibaba, you get a bull flag. Right? If you're lucky here, and then the market can still go higher. But again, I don't see without the U.S. resiliency, Alibaba, China, Germany, everything non-U.S. going way, way, way higher for another leg without having the U.S. at least show that, hey, look, the U.S. is in a recession. Now, data points to a non-recession year for the U.S. Like fundamentally, here's honestly, this is probably the most important thing for the recession talk. Initial jobless claims. You can zoom in on this. You can see this every Thursday that prints in the economic calendars. Unless this thing starts to spike higher, dramatically higher, we are still at very low unemployment. Unemployment rate is still 4 point. That can't be right. Is that right? That's what the Fed was projecting for the rest of the year. So between jobless claims, this is continuing, this is initial. If this starts to spike up aggressively, then we can have this talk about stagflation and recession. If this stays steady, here's the thing. Everyone talks about stagflation because, slowing growth and higher inflation. If you don't have higher unemployment, you won't have stagflation. Stagflation has happened like twice in the last 40 years, and it was like a 6-month window, and it was over. So the only way it gets worse is if unemployment claims get way better or way worse. And a lot of these are going to be suppressed because the federal government firings and layoffs and furloughs are going to be until like September. They're getting paid through September. So that's when we make this like big decision of like how bad the jobs market's going to get. But I think right now, maybe people aren't like just jumping ship and going to another job because they think they can and get paid more. I think right now people are like, I'm happy I have a job. I'm going to keep it. I'm going to stick around for a while. Okay. Also, something very scary was by 2045, as we see the labor market right now, about 90% of the labor market could be replaced by AI by 2045. The human element is going to be like either a premium, where if you're a carpenter, electrician, a trades, construction, if you're in the service industry, I mean, a hairstylist, like person to person could be at a premium. but those jobs are few and far between. Like service sector could grow, healthcare could clearly grow, but it's crazy to think that, like, I know it's a long ways away, but 20 years, it's in our lifetime. Um, that makes for a really interesting labor market. So, and I don't think the world of coders is like, they're not going to have jobs because you're going to have one coder that rules them all. So anyway, that was a pretty ominous fact of like where things are going right now at the rate of AI. So anyway, point is, on a recession talk or stagflation talk, the only way this gets to true stagflation or we get into recession talks would be if the jobless claims and the labor market gets way, way, way softer, which right now it is not. So we can have we can have slowing growth and we could have 2 quarters of slowing GDP, but it doesn't necessarily trigger recession. We could also have a rolling recession, which is a lot like we experienced in 2022 when the market was down 20 to 30%, but it wasn't felt by like every sector individually. So who knows? All right, what else? Advanced decline line. This is another way I'm watching the timing of the market. There's your 50-period moving average on the S&P. Here's your 50-period moving average on the Nasdaq. Another opportunity for mags and Nasdaq. I know Nick likes to trade QQQ a lot. He likes to trade tech a lot. I wouldn't be surprised if there is such a flush that we actually see some of these really attractive levels to get long. So this is why I'm saying I don't think the bottom is in necessarily, but watching closely. Okay. Some other stocks here, Costco, off the 200 moving average. I still think this is a rally to fall. I think we just have a lot of things that have gone straight up. At the very least, just think of like basic Elliott waves and technical analysis. If you go up, 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 a lot of times it's just a correction. A lot of times it's wave structure. So a high, low, lower, high, lower, low, then there's a buying opportunity. So this high to low, do we have something like that? Okay. How about Walmart? Walmart has fallen enough. Same type of thing. Do we like build off this low? Walmart goes up. Sure. It pulls back to maybe like the 92 zone, 93 zone. Is it high, low, lower, high, lower, low? If the consumer really starts to pull back and the consumer is the big concern, yeah, Walmart can drop, right? Walmart is up a ton. It is up at a multiple it's never seen before. It was trading like a momentum stock, for crying out loud, with this rally. From the bottom in 2023, I mean, this is insane. December 2023, it's up 111%. I mean, I don't think Walmart has ever seen that type of appreciation without having some type of correction. So, yeah, a lot of crazy stuff. Nike sold some puts at 55.50 and 47.50. Home Depot, your big, house purchases, probably going to suffer a little bit. I'd like to maybe scoop these up in this strong support zone. MasterCard hanging in there. AXP at 264. This one I'm watching out to. This one I closed out for profit. But I still have a ratio spread out to May. Let me double check that one here. So this is AXP. Yep. So watching May 16th expiration. If I do take shares of AXP, it's going to be at a pretty cheap price. I get a $10 discount plus the 280 spread, or the 280 credit on the ratio spread. So it'll be like 247 that I own it, which is pretty decent. I mean, I can actually be well below these lows, which would be nice if I need it. Johnson & Johnson probably still looking to go into healthcare. So looking at good old, what's the sector for healthcare? XL healthcare, XLV. XLV. I was hoping we would have some of this in here. High, low. I mean, this could either be a bullish pattern in the making where this market, breaks the trend line, is sitting here with a bullish look, like healthcare looks pretty good. Or of course, I mean, I just take a little stab at it, a little nibble for entry 1, and then look for some resistance levels back here, entry 2 and 3. But I think healthcare in the next 2, 3, 4, 5 years, probably one of the better performing sectors, especially if things slow down. It's not super correlated. So 0.46, which is way less beta than the S&P. But I mean, I mean, it depends on people lose their jobs. If all of a sudden it's like, oh, well, hospitals are going AI and generative AI, are they firing people? I would hope not, but you never know. And then XLU, probably my other favorite sector right now, is XLU. XLE is pretty good as well. XLE has been really resilient. These are closing up for expiration today for full credit. I still like energy. This also plays in, this isn't just like oil, right? This is, if we're looking for energy in general, coal's in play, oil's in play, natural gas is in play. nuclear's in play, like this would be uranium, anything. So, I mean, if we want to build out AI, we want to have any type of growth. Energy is going to be a big source of it in order to make it happen. If we, I mean, imagine having this big plan to be AI everything, but not having the infrastructure to support it. And that's what the question is. It's like we need more data centers. Need more infrastructure. And so even some of these utility companies, Duke Energy, Constellation Energy, these stocks are at all-time highs. You know, Constellation Energy. Pretty nasty pullback there. Why? I mean, I'd look to see like what is the difference between this stock and another one. But if there are companies in the utility sector that are sitting near highs, like I wouldn't mind having those plays be more momentum to the upside. Make sense? All right. Just a couple more minutes. Let's do, what do you want to see? You want to see some currencies? Aussie CAD still hanging in there. I like this one as far as range. Buying the lows, buying the lows, buying the lows. Still, to me, this is a low to high. Just play the range. Wouldn't worry about that one very much. Gold's at all-time highs. Enjoy the run. It's either capitulating higher for like a crazy run that I would want to protect and profit, or we're due for a pullback. I'm not buying gold at all-time highs. Period. We have one of the biggest runs from a 370 plus bar count, and we have like 15% overextended from the 200 moving average. It's going to pull back at some point. I don't know when. I'm not calling the top, but I want to pull back or a dip before I get long gold, at least adding to my positions. Otherwise, if it runs to 32, 33, 3,400, I will be protecting profit on the way up because we're likely going to have a reversion. Okay, silver, let it run. Silver with gold, it's like gold's at all-time highs. Silver's still well behind that. I want to see if silver can play catch up. Okay, Aussie Swiss, I'm still in. Aussie yen crosses in general. Be careful on the yen pairs, as I always say. Aussie New Zealand, I'm still long. Looking to stay in this bullish channel to see if we get up towards the 113, 114 handle. Aussie dollar staying out, but we'll be watching. I'm going to buy this thing around 6,000 if I can get it. CAD Swiss, energy's up. We'll see if CAD Swiss is one of my bigger stack positions. CAD yen, Swiss yen, who cares? Euro Aussie, right back up to the highs with some risk off trading. Be careful on these pairs. Like this to me was a big turnoff watching price do something like that. That makes sense? So like this run for 1,000 pips, no thank you. Like be careful on calling the top because clearly this was running with risk off. This market, if we go risk off, like Aussie's going to get crushed compared to the euro, compared to the dollar, compared to the Swiss, perhaps. And the yen is thrown in there as well. But I just be careful. There's high volatility on these. So I mean, I could see yes, like we could hit this resistance. Look for your shorter time frame confirmation, then maybe flag back down. But I want to be trading, what I see on a smaller time frame, which is rolling over, stop loss, or confirmation to enter, and then stop loss area above to make sure you've got something to trade. But I'm not just calling the top here. I think that's maybe a foolish thing to do. Now, again, this is what the market can do. We have an area of resistance. It could go also a little bit higher, create divergence, and then come all the way back down, and then be a topping pattern. And you give it time, and it comes all the way back to equilibrium. Forex markets do that all the time. When it goes up inefficiently, it typically finds a way to balance. So I wouldn't be surprised if we see a topping pattern there, but just be careful on how you trade it. EuroCAD, same type of thing. If we go straight up and we have a high, low, lower, high, lower, low, come back down. If we go straight up and we come back to the same highs, watch this level or divergence and then see if it works its way back down. So, I mean, I'm watching that resistance level. I just don't like the trade and how volatile these have been. Euro Swiss, I'm staying long. Euro Pound, I'm out. Euro Yen, I'd say leave it alone. Euro New Zealand, same thing. Maybe. Watch for divergence, but be careful. Euro Dollar, I'm going to stay long, small bites. Pound Aussie's up to fresh highs. Maybe some divergence if you're lucky. If this structure breaks and rolls over, maybe that's a good confirmation. Something like this, like a rising wedge, and then it rolls over. Otherwise, it's just high and you follow your trends. Pound CAD, same thing. If we go straight up, is it high, low, lower, high, lower, low? Is it testing the highs again to flag or go back down to equilibrium? Just aligning those higher time frames with smaller time frames. Pound Swiss, I'm long. Pound yen, no trade. Pound New Zealand, same thing, like pound Aussie. Pound dollar, leaving this one alone. New Zealand CAD is falling, but I'm still going to dollar cost average into this one. I like this trade. I think we still get back to these highs. Just It's going to be a boring currency pair, which is honestly kind of my favorite. I love boring currency pairs that I can get some positive swap. Here is New Zealand Swiss that I'm getting some positive swap on, but revisiting these flash crash lows from August 2024. New Zealand yen coming back into these lows. Watch how that low behaves. New Zealand dollar out of that position, waiting to see if I can buy again, maybe at the same lows. Maybe at the same lows. Right? Could it go lower? Sure. I wouldn't mind taking a ride from 5,500 down to 5,000, but to me that sets up for a monster New Zealand dollar trade. Hopefully. But nothing yet. Dollar CAD, nothing. I think this is just total chop. So maybe this type of structure here, high, low, putting it at top, very, very indecisive, and then maybe it rolls over. Is dollar weaker and oil stronger? Maybe. If oil gets weaker, then I don't see the CAD getting necessarily stronger. I really don't like this currency pair. I think this to me is like one of my favorite trades I've had in years on the dollar CAD, and the rest has been just range if you're lucky. So I think it's just back into kind of consolidation mode. Dollar Swiss, keep an eye on it. We're at the halfway pullback zone. If it pulls back deeper, that's fine. I'll load back in. If it goes back to 92, that's fine. But I'm not in anything right now. Dollar yen. I've talked about this like maybe a bear pattern. This level here, left tip, center tip. Slowly kind of pulling back into the zone. Wouldn't mind seeing a bear pattern emerge. Wouldn't mind seeing another play to the downside. Is this Japanese yen deleveraging? Is this dollar weakness? Is this the risk off, sentiment in the market? Could be a combination of any of those things. But it's not an easy trade. So unless I see something very clean on this dollar yen and I have defined risk, I've got to see something very clean. And I just stack some sell stop orders and see if I'm right. It's very difficult to trade these currency pairs, especially with negative swap. The market is kind of torn between positive swap, where they just hold long, and then a deleveraging, which is dump all those positions and then crazy high volatility. I just did the entire currency market, Lee. Aussie Swiss. I just got levels in. I'm just buying all the way down here to this flash crash low. So I'm willing to buy and then wait and see if this plays out with something like this. Either connect these highs, and it could just be going lower, 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 lower. Find the flash crash lows, look for a bottoming pattern, and I'm going to start moving these trades right here. I'll start moving these trades down. If I see bullishness, I'm going to move these trades down and stack this all the way back up to get back to this high, or these pockets way back here. So what I want to see is, can I find a bottoming pattern on this Aussie Swiss? And if I can get it, I'm going to make a lot of pips. There you go. Okay, that's it. I'll let you go for today. Back at it tomorrow. Thanks, everybody.
Thanks for watching today's A1 Trading Show. Be sure to subscribe and to turn on notifications so you don't miss the next one. Want more from A1 Trading? Check out the links in the description below, or our website a1trading.com. We have lots of free trading tools and channels available for you. We hope you have a great rest of your day, and we'll see you tomorrow.